Welcome back to the Deep Dive. Today, we are doing something, well, a little different. Usually we take a broad topic and kind of swim around the surface,
Yeah.
maybe dive down for a specific pearl of wisdom.
A lot different, I'd say.
Yeah, you're right. But today we are putting on the heavy deep sea diving gear. We're going all the way to the bottom of the ocean.
We certainly are. And honestly, if you're in the financial world or even just looking at your own portfolio, this is the bedrock. We are talking about mutual funds, but not just in a casual what is a mutual fund way. We are tackling specifically Chapter 11 of the NISM Series-X-A Investment Advisor Certification.
Right. And I have the source material here in front of me. This isn't a brochure. This is dense. We're talking legal structures, mathematical formulas for net asset value, and very specific regulatory categorizations, the plumbing that makes it all work.
It is dense, but it is also the bread and butter of the Indian financial advisory landscape. If you're prepping for this exam, you just cannot skim this chapter. You can't just know roughly what a large cap fund is. You need to know the exact SEBI definition. You need to know the precise timeline for a liquid fund. So consider me your mentor for this session. We are going to strip this down bolt by bolt.
I love it. I'm the student today. I've got my calculator out. I've got my notepad, and I'm ready to be grilled. So let's start at the very top. Section 11.1, the basic definition.
Let's do it.
The text defines a mutual fund as a vehicle to invest in an asset class like equity, debt, gold, or real estate for those who don't want to invest directly.
Correct. It's a pass-through vehicle, a way to pool money from lots of different people. But the part that usually trips people up on the exam isn't that basic definition.
What is it then?
It's the cast of characters, the legal structure. When you buy a mutual fund, you aren't just giving money to a company, you are entering a specific legal arrangement.
A trust, right?
Exactly, it's a trust.
Okay, let's unpack that. I see a list of entities here. Sponsor, trustees, AMC, custodian. It feels like a lot of cooks in the kitchen. Why do we need so many different bodies?
It's all about separating powers and avoiding conflicts of interest. In the old days, or in, unregulated markets, you might give your money to one guy who picks the stocks, holds the cash, and writes the reports.
And if that one guy runs away?
You're done. The whole thing collapses. The Indian mutual fund structure, which is actually very robust, splits these powers up so that no single entity has total control.
Okay, so walk me through the hierarchy. Who kicks it all off? Who starts it?
That would be the sponsor. You can think of the sponsor as the promoter.
The promoter thing.
This is the entity, usually a big bank or a financial institution, that wants to set up a mutual fund business. They put up the initial capital. They go to SEBI and say, we want to launch a fund.
So if I see ABC Mutual Fund, it's very likely that ABC Bank is the sponsor.
Exactly. But here is the key distinction, and you have to get this for the exam. The sponsor does not hold your money. Once they've set up the trust, they kind of step back.
So the fund itself is constituted as a trust.
Yes. And the guardians of that trust are the trustees.
The trustees. So their job is to, what, guard the vault? Is that a fair analogy?
Metaphorically, yes. That's a great way to put it. The trustees hold the property, the cash, the stocks, the bonds and trust for the benefit of the investors.
The unit holders.
For the unit holders. They are the watchdog. Their entire job, their fiduciary duty, is to ensure that the sponsor and the managers are acting in your best interest, not their own. They have legal ownership of the assets, but they don't manage them day to day.
Okay, so the sponsor starts it, the trustees guard it, but who actually picks the stocks? Who is making the call to buy or sell something?
That is the asset management company, the AMC.
The AMC.
The trustees appoint the AMC to manage the funds. The AMC is the entity that hires the fund managers, the research analysts, the dealers. They're the ones doing the marketing. When you say, I'm investing with this fund house, you're actually interacting with the AMC.
So the AMC is the brains, the trustee is the conscience, and the sponsor is the parent who sets it all up.
That is a perfect way to visualize it. And there are two more crucial players you need to know for the exam.
Okay.
First, the custodian.
The custodian.
Yes. So even though the AMC buys the stock, the AMC doesn't actually keep the share certificates in a drawer in their office.
Right.
The custodian holds the securities. They are responsible for the safekeeping of the assets. It's another layer of safety. The person making the trade, the AMC, is not the person physically holding the asset. That's the custodian.
Another separation of powers.
Exactly. And the last one...
I see it here. The R&T agent.
The R&T agent, registrar, and transfer agent. Companies you might have heard of, like CAMS or KFintech.
Ah, okay. The record keepers.
They are the record keepers. They maintain the entire back-end database. Who owns how many units? Who just updated their email address? Who needs a tax statement sent out? The AMC outsources all that massive administrative headache to the R&T agent.
And the text really emphasizes this point. Every single one of these entities, sponsor, trustee, AMC, custodian, is regulated by SEBI.
Absolutely. SEBI acts as the overarching regulator of this entire universe. They ensure eligibility, financial soundness, and that everyone stays in their own lane. You should definitely flag this for the exam. All these core entities fall under SEBI's purview.
Okay, that makes sense. Moving on to how a fund is actually born. The text mentions the NFO, the new fund offer.
Right. So when an AMC decides it wants to launch a scheme, a new product, they can't just start selling it.
Right, they need permission.
They need to file an offer document with SEBI. This document contains everything: the investment objective, the costs, the strategy. Once SEBI gives the green light, they can open the NFO. It's the launch window.
It sounds a lot like an IPO for a company, but this is for a fund.
It is, but there's a crucial difference. In a stock IPO, the price is determined by demand. It can skyrocket on day one if there's a lot of hype.
Right.
In a mutual fund NFO, the price is usually fixed, typically at 10 rupees per unit. You aren't bidding for it, you are just getting in at the ground floor price.
Speaking of 10 rupees per unit, let's get into the math.
Nah.
Section 11.2 covers key concepts. The first one is the investment objective.
This is your North Star. Every single scheme must have a clearly stated investment objective. It dictates the asset class, like equity or debt, the type of securities, and the risk level. Suitability depends entirely on this. You cannot match a client to a fund without matching the objective.
And then we get to units. I think most people understand shares, but units could be a little confusing. The text gives a calculation example. Let's just walk through it because I want to make sure I get the decimals right.
Let's do it. It's a simple concept. Your investment is represented by units.
So the example is an investor puts in 5,000 rupees. The price per unit is 10 rupees.
Right. So the calculation is just 5,000 divided by 10. That gives you 500 units.
Simple enough.
But what if the price, the NAV, isn't a round number? What if it's, say, 14 rupees and 50 pays?
Then 5,000 divided by 14.50 isn't going to be a whole number.
Exactly. You'd get something like 344.8275 units. And you should flag this for the exam. Mutual fund units can be allotted in decimals, up to 4 places usually.
Unlike shares, which you generally buy in whole numbers.
Correct. Mutual funds ensure your entire investment amount is working for you right down to the last paisa.
Okay, now the big one. NAV, net asset value. This is the price per unit. Section 11.2.3 has a formula and a table that I really want to spend some time on because this is the engine of the whole system.
Agreed. It's fundamental. Let's visualize the formula first before we get into the numbers.
Okay.
Net assets equals the market value of the portfolio plus any current assets like cash minus all the liabilities and expenses.
So basically assets minus liabilities. That gives you the total pot of money the fund actually owns.
That's the total pot. To get the NAV, you then divide that total net assets by the total number of outstanding units.
Pot of money divided by number of spoons.
Exactly. That's the value of 1 spoon.
Now, let's run through the scenarios from the text because I think they clear up a massive misconception that I've seen people have.
Go for it. Let's walk through them.
Scenario 1. The fund launches. It collects 100,000 rupees from investors, and at 10 rupees a unit, it issues 10,000 units.
Okay.
So the calculation is 100,000 divided by 10,000. That gives us a starting NAV of 10 rupees.
Standard stuff. That's every NFO.
Scenario 2. The markets do well. The portfolio value increases to 120,000 rupees. Nobody has bought or sold any units yet, so we still have 10,000 units.
Right.
The calculation is now 120,000 divided by 10,000, which equals 12 rupees.
So the NAV went up because the assets inside the fund went up. Easy enough.
Now here's the tricky one. This is the one that blows people's minds. Scenario 3.
Okay, the redemption.
An investor decides to leave. They redeem 1,000 of their units. The NAV, as we just established, is 12 rupees.
Right, so the fund has to pay them 1,000 units multiplied by 12 rupees. That's 12,000.
So 12,000 rupees goes out of the fund. Now let's look at the totals. The net assets. They drop from 120,000 down to 108,000.
Correct.
And the outstanding units also drop from 10,000 units down to 9,000.
Okay.
So to find the new NAV, we divide 108,000 by 9,000. And the answer is
It's still 12 rupees.
Still 12.
Boom! Did you catch that? The size of the fund, the AUM, it shrank. But the NAV did not change.
That is the aha moment. In the stock market, if a huge investor sells a massive block of shares, the share price crashes because of supply and demand. But here, one person's redemption doesn't hurt the remaining investors at all.
Not one bit. Think about it like a pizza again. If you and I are sharing a pizza with 10 slices and you take your one slice and leave, my 9 slices don't suddenly get smaller or less choosy. The whole pizza is smaller, but the value per slice remains constant. This is a critical exam concept. Redemptions and purchases do not alter the NAV. Only the market movement of the underlying securities alters the NAV.
That is crystal clear now. One more detail on NAV mark-to-market, section 11.2.6.
Right. This is the rule that says the AMC must value the entire portfolio every single day at the end of the day. If the fund owns shares of Reliance, well, that's easy. You just take the closing price on the National Stock Exchange.
But what if it's something less common?
Exactly. What if the fund owns a corporate bond that hasn't traded in a week? You can't just use the old price. It's stale. It's not a true reflection of the value.
So what do?
SEBI has strict valuation norms. You have to estimate the fair price based on current interest rates and credit risk. This ensures that the NAV you see is the true value of the portfolio right now, not a historical guess.
And that leads directly to cutoff timings, right? Section 11.2.5. Because the NAV changes daily, when I ask to buy or sell matters.
Hugely. It's all about fairness. You can't look at the market at 3:25 p.m., see that it's up 2%, and quickly put in a buy order to catch that gain. That would be cheating.
So there's a deadline.
There's a cutoff time. Usually it's 3 p.m. for most equity funds. If you submit your application before the cutoff, you get the NAV of that day. If you submit it after the cutoff, you get the NAV of the next business day.
So you're always buying blind, in a sense.
You are. You don't know the exact NAV at the moment you click buy.
Got it. Now let's zoom out a bit to section 11.3, fund architectures. We have open-ended, closed-ended, interval, and ETFs. I think most people deal with open-ended.
Yeah.
That's the standard, right?
Yes, that's the vast majority of the industry. Open-ended means the door is always open. You can buy or sell units continuously every business day at the current NAV. The fund has an indefinite life. It goes on in perpetuity. And importantly, its unit capital fluctuates daily as people enter and exit.
Okay, so contrast that with closed-ended.
The door is locked. You can only buy units during the NFO period. Once that window closes, the capital is fixed. The fund then runs for a specific tenor, say 3 years or 5 years.
So if I have an emergency and I need my money back in year 2 of a 3-year fund, am I just stuck?
You can't go back to the AMC for a refund, no. However, SEBI mandates that all closed-ended funds must be listed on a stock exchange.
So there is an exit route.
There is an exit route. You can sell your units to another investor on the secondary market, just like a stock. But be warned, the liquidity is often terrible. You might have to sell your units at a deep discount to the actual NAV just to find a buyer.
Okay, then we have interval funds.
These are a hybrid. They are mostly closed, but they open the window for transactions at specific predefined intervals, say, for 2 days every quarter.
And the text has some specific numbers for this.
It does. Flag this for the exam. The transaction window must be a minimum of 2 days, and the gap between these windows must be at least 15 days.
Got it. And finally, the rock star of the last decade, ETFs, or exchange-traded funds.
ETFs are fascinating. They are mutual funds. They hold a portfolio, usually tracking an index like the Nifty 50, but they trade like stocks.
So it's a mutual fund that you can trade all day.
Exactly. In a normal mutual fund, you get one NAV at the end of the day. With an ETF, the price fluctuates second by second on your trading screen. You can buy at 10 a.m. and sell at 10:15 a.m. And generally, you're trading with other investors on the exchange, not directly with the fund itself.
Okay, section 11.4 brings us to the regulatory framework. We already mentioned SEBI is the big boss.
Yes, SEBI, the Securities and Exchange Board of India, is the primary regulator. They make the rules, protect investors, and inspect the funds.
Who else is involved?
The RBI gets involved when funds are investing abroad or when banks act as sponsors because they regulate the banking system. And then there is AMFI.
AMFI. The Association of Mutual Funds in India. Are they a regulator?
No, and that is a classic exam trap. AMFI is an industry body.
So what do?
They recommend best practices, they run investor awareness campaigns, they conduct the exams like the one you're studying for, and they represent the industry to the government. But they don't have the legal teeth that SEBI has. They are the voice of the industry, not the police.
Okay, good distinction. I see a note here about a recent update, MF Lite.
Yes, this is flagged in the text. On December 31st, 2024, SEBI rolled out what they're calling MF Lite regulations, and these are specifically for passive funds.
Passive funds like index funds and ETFs.
Exactly. The logic is this. Passive funds, which just track an index, carry less risk of mismanagement than active funds because the manager has very little discretion. Therefore, they might need a lighter regulatory burden. Just keep that date and concept in mind. It's a move to encourage more passive investment options.
The text also mentions investor service standards.
Right. SEBI prescribes very strict turnaround times. You can't just take an investor's money and process the application next week. There are strict timelines for allotment of units, refund of money, sending out account statements. It's all regulated to build and maintain trust in the system.
Okay, brace yourself. We are now entering the belly of the beast, section 11.5, mutual fund products.
Yeah.
This is where the exam gets really tricky because of all the different categorization rules.
It is dense, but there's a logic to it. SEBI mandated that asset management companies can only have one scheme per category. You can't have blue chip fund A and blue chip fund B that do the exact same thing. This was done to reduce clutter and confusion for investors.
But there are exceptions.
There are. The exceptions are for index funds, ETFs, sectoral funds, and fund of funds. But for the main active categories, it's one per AMC.
Let's start with equity schemes, 11.5.1. And before we do that, we need to define the market caps. The text says these are exam flags must memorize.
Absolutely. Do not guess these. You have to know them cold. Urge cap. The top 100 companies by full market capitalization. So that's rank first to 100th.
Top 100, got it. Mid cap.
The next 150 companies. So that's rank 101st to 250th.
And small cap.
Everything else, rank 251st and onwards. Simple as that.
Okay, clear cut. Now let's run through the specific equity categories. I'll name them. You give the rule.
Let's do it.
First, large cap fund.
Must invest at least 80% of its total assets in large cap stocks. These are your stable blue chip giants.
Mid cap fund.
Must invest at least 65% in mid cap stocks. More growth potential, but also more volatile than large caps.
Large and mid cap fund.
This is a blend. It needs a minimum of 35% in large cap stocks. ND a minimum of 35% in mid cap stocks. That adds up to 70%, leaving 30% for the manager to play with.
Okay, small cap fund.
Minimum 65% in small cap stocks. High risk, high volatility, high potential reward.
Now here's where people get confused.
Yeah.
Multi-cap versus flexi-cap. To the layman, they sound exactly the same.
They do, but for the exam, you have to treat them as opposites.
Oh, great.
A multi-cap fund has a rigid rule, sometimes called the 252-525 rule. It must invest at least 25% in large cap, 25% in mid cap, and 25% in small cap.
So it's forced to be diversified across all sizes.
It is mandated. It has no choice. A flexi-cap fund, on the other hand, is completely free. It just needs a minimum of 65% in equities overall. The manager can put 100% in large cap today and switch to 100% in small cap tomorrow if they want. There are no sublimits.
So multi-cap equals mandated diversity. Flexi-cap equals manager's choice.
Precisely. That's a perfect way to remember it.
What about sector and thematic funds?
Sector funds invest in one specific industry, like banking or IT or pharma. They must invest a minimum of 80% in that one sector. These are very high risk because of the concentration. If that sector crashes, you have nowhere to hide.
And thematic.
Thematic funds are broader. The theme might be something like infrastructure or ESG, which stands for environmental, social, and governance. They invest in companies across different sectors that all fit that central theme. Also, a minimum of 80% in stocks related to the theme.
Okay, then we have strategy-based funds. First, value funds.
The strategy here is to buy stocks that the manager believes are undervalued by the market. Minimum 65% of assets invested with this value strategy.
And contra funds?
A contrarian strategy, betting against the herd, buying unloved sectors or stocks that are currently out of favor.
Is there a rule about those two?
Yes, there is. An AMC can offer a value fund or a contra fund, but not both. SEBI considers their strategies to be too similar.
Okay. Dividend yield funds.
These funds invest in companies that have a track record of paying high dividends, minimum 65% in such stocks. They're usually more stable, cash-rich companies.
Focused funds.
This one is all about concentration. The portfolio can hold a maximum of only 30 stocks. It has to invest at least 65% in equity. It's a high conviction bet on a small number of companies.
And finally for equity, the big one for tax savers. ELSS, Equity-linked savings scheme.
The tax saver. 3 exam flags here. You must know all 3.
Go.
1. Investments are eligible for a tax deduction under Section 80C up to 1.5 lakhs. 2. It has a statutory lock-in period of 3 years. You cannot touch the money before then. And 3. It must have a minimum of 80% invested in equity.
Okay, take a breath. That was a lot. That was just equity.
Deep breaths.
Now we dive into debt funds, 11.5.2.
Yep.
I feel like students struggle here because the terminology is less familiar. Things like Macaulay duration, credit risk.
Let's simplify it. There are 2 main risks in any debt fund. You have to understand these first.
Okay.
Number 1 is credit risk. This is the risk that the borrower, the company that issued the bond, might default. They just don't pay you back.
Simple enough. What's the second one?
The second is interest rate risk. This is like a seesaw. When interest rates in the economy go UP, existing bond prices go down. And when interest rates go down, existing bond prices go UP.
It's an inverse relationship.
It's an inverse relationship. And the concept of duration just measures how sensitive a bond or a portfolio of bonds is to this seesaw. A bond with a long duration is very sensitive. If rates rise 1%, its price might crash 7 or 8%. A bond with short duration barely moves.
Okay, that helps a lot. So the categories are basically a ladder of duration or interest rate risk.
Exactly.
Let's climb it. I'll say the name, you give the definition. Overnight fund.
Easiest one. Maturity of 1 day. It's basically just parking cash for a night, almost 0 risk.
Liquid fund.
Invest in debt securities with a maturity of up to 91 days. Very popular for corporate treasuries to park short-term cash.
Ultra short duration fund.
Now we switch to Macaulay duration. For this one, the Macaulay duration of the portfolio has to be between 3 and 6 months.
Low duration fund.
Macaulay duration between 6 and 12 months.
Money market fund.
This one invests in money market instruments like commercial paper or treasury bills with a maturity of up to 1 year.
Short duration fund.
Macaulay duration between 1 and 3 years. This is a sweet spot for many medium-term investors.
Medium duration fund.
Duration between 3 and 4 years.
Medium to long duration fund.
Duration between 4 and 7 years.
And finally, long duration fund.
Duration greater than 7 years, the most sensitive to interest rate changes.
That is a lot of numbers to remember for the exam.
It is, but notice the progression. 1 day, 91 days, 3 to 6 months, 6 to 12 months, 1 year, 1 to 3 years, 3 to 4, 4 to 7, and then 7 plus. It follows a continuous timeline.
Okay, now let's look at the debt funds defined by credit or asset profile. First, corporate bond fund.
This is a high-quality fund. It has to invest a minimum of 80% of its assets in corporate bonds that are rated AA+ and above. This is for safety-conscious investors who are worried about defaults.
And its opposite, credit risk fund.
Right, the risky cousins. These must invest a minimum of 65% in corporate bonds rated AA and below. They are deliberately chasing higher yields by taking on more default risk.
Banking and PSU fund.
This one invests a minimum of 80% in the debt instruments of banks, public sector undertakings, and public financial institutions. These are generally perceived as safer because of the government or quasi-government backing.
Gilt funds.
Gilt is just another word for government securities, or GSECs. So these funds invest a minimum of 80% in GSECs.
So no credit risk, right?
0 credit risk, because the government won't default. But, and this is a huge but, they can have very high interest rate risk depending on the duration of the GSECs they hold. Do not mistake gilt for risk-free.
Good point. And there is a specific type, gilt fund with 10-year constant duration.
Exactly what it says on the tin. Minimum 80% in GSECs, managed in such a way that the portfolio's duration is maintained constantly at 10 years. This is a pure play on interest rates for sophisticated investors.
Dynamic bond fund.
This is the go-anywhere debt fund. The manager can shift the duration of the portfolio freely based on their view of where interest rates are headed. If they think rates will fall, they'll buy long-term bonds. If they think rates will rise, they'll move to short-term stuff. It relies heavily on the fund manager's skill.
Floating rate fund.
This fund invests a minimum of 65% in floating rate instruments. These are bonds whose coupons reset periodically with the market rates, so they have very low interest rate risk.
And lastly, for debt, what are fixed maturity plans, or FMPs?
These are closed-ended debt funds. The logic is simple. If the scheme has a tenure of 3 years, the manager buys bonds that also mature in 3 years and just holds them until maturity. This completely eliminates interest rate risk because you aren't selling the bond early, you're just collecting the maturity value at the end.
Phew. Okay, on to the next section. Section 11.5.3, hybrid funds. the ones that mix equity and debt.
Right. Let's start with the conservative hybrid fund. This one is debt-heavy. It invests only 10 to 25% in equity and 75 to 90% in debt. It's aimed at generating regular income with just a tiny bit of growth.
Okay, balanced hybrid fund.
This one is 40 to 60% equity and 40 to 60% debt. The text notes that this category is actually rarely used these days because of the tax rules, but it still exists on paper.
And the most popular one, the aggressive hybrid fund.
This is equity heavy, 65 to 80% in equity and 20 to 35% in debt. This used to be called a balanced fund in the old days. Because it holds more than 65% in equity, it gets equity tax treatment, which is a big deal.
What about dynamic asset allocation or balanced advantage funds?
These are the most flexible of all. They can move from 0% to 100% in either equity or debt, depending on a predefined model. They're designed to automatically reduce equity exposure when markets are expensive and increase it when they are cheap, reducing volatility.
Multi-asset allocation fund.
The rule here is that it must invest in at least 3 different asset classes. Usually that means equity, debt, and gold. And it has to hold a minimum of 10% in each of those 3.
Arbitrage funds. This one is a favorite for high net worth individuals. Can you explain why that is?
Sure. An arbitrage fund exploits the tiny price difference between the cash market and the futures market for a stock.
For example,
They might buy Reliance in the cash market for 1,000 rupees, and at the same instant, sell a Reliance future for 1,002 rupees. They lock in a 2 rupee profit. It's essentially risk-free in terms of market direction.
so it acts like a liquid fund.
It acts like a liquid fund, giving stable, low-risk returns. But here's the insight. To do this, it holds a minimum of 65% in equity and hedged positions. Therefore, the taxman treats it as an equity fund. You get the safety profile of debt with the tax benefits of equity. That's the magic.
Equity savings fund.
This is a mix of everything. It holds some pure equity, some arbitrage positions, and some debt. The rule is a minimum 65% in equity and equity-related instruments, including the hedged positions, and a minimum of 10% in debt.
And capital protection funds.
These are always closed-ended. They structure the portfolio so that the debt portion is designed to grow to cover your initial principal by the end of the term, while a small portion invested in equity options tries to generate some upside. But remember, the name is capital protection-oriented. In mutual funds, returns are never guaranteed.
Moving to solution-oriented funds, 11.5.4. This includes retirement funds and children's funds.
The key feature here and the big exam flag is the lock-in. You are locked in for at least 5 years, or are until retirement age, or the age of majority for a child, whichever is earlier. It's designed to enforce long-term discipline.
Okay, next up, section 11.5.5, other funds. We have fund of funds or FOFUF.
This is pretty simple. It's a fund that invests in other mutual fund schemes. The rule is it must invest a minimum of 95% of its assets in these underlying funds.
And there's a big tax flag here, right?
A huge one. The text explicitly mentions the budget of July 2024. As of that budget, equity fund of funds do not get equity tax treatment anymore. They are now taxed at 12.5% plus surcharge and cess if held long-term. This is a major, major change, so you need to remember that.
Okay. Gold and silver ETFs.
These just track the domestic prices of the metals. There are purity checks you should know. Gold must be 99.5% pure, and silver must be 99.9% pure. Also, gold ETFs are allowed to invest up to 20% of their assets in gold deposit schemes of banks.
What about real estate mutual funds or REMFs?
The rule here is that they must invest a minimum of 75% in physical real estate assets or in mortgage-backed securities. And they can invest a maximum of 35% in the securities of listed real estate companies.
And infrastructure debt schemes.
These are closed-ended funds with a minimum tenor of 5 years. The key thing to flag here is the investment size. The text says the minimum investment for any single investor is 1 crore rupees.
1 crore.
Yes, and the minimum face value of each unit is 10 lakh rupees. This is for big institutional players, not the retail guy putting in 500 rupees a month.
And finally, a new category mentioned in section 11.6, specialized investment funds.
Right. This is SEBI's attempt to create a middle ground product between retail mutual funds and high-ticket PMS, or portfolio management services.
What's the ticket size here?
The minimum investment is 10 lakh rupees.
And who is it for?
It's for sophisticated investors. These funds can pursue higher risk strategies. They can use derivatives for more than just hedging. It's for people who want higher potential returns and can stomach the high risk, but don't necessarily have the 50 lakh rupees needed for PMS.
All right, that covers the entire product catalog.
Mm-hmm.
Now let's talk about the operations side of things. Section 11.7, triggers.
Triggers are basically like setting an autopilot for your investments. You can give the fund house a standing instruction. For example, if the NAV of my fund hits 20 rupees, please redeem all my units.
Or a switch.
Or a switch. If the BSE Sensex falls by 1,000 points in a day, please switch my money from the liquid fund to the equity fund. It helps investors execute a plan without having to watch the screen all day.
Section 11.8, purchase and redemption. The text mentions a folio. Is that just an account number?
Basically, yes. Think of a folio as your customer ID with that specific fund house. You can have multiple investments in different schemes all under that one folio number. It just makes tracking easier.
Okay, redemptions. I want my money back. The text notes that the proceeds are credited to your registered bank account. What about for NRIs?
For NRIs, it depends entirely on where the money came from in the first place.
Okay.
If they invested from their NRE account, which is for repatriable funds, the redemption proceeds go back to the NRE account. If they invested from their NRO account for non-repatriable funds, it goes back to the NRO account. You can't mix those two streams.
I see a very scary sounding clause here. The crisis clause, which came from a May 2020 circular.
Yes, this came about directly because of the Franklin Templeton crisis, where 6 of their debt funds shut down for redemption overnight. They couldn't sell their bonds to pay departing investors because the market for those specific bonds had completely dried up.
So what does SEBI do?
SEBI introduced a new rule. It says that if a scheme is being wound up or shut down, it must be listed on the stock exchange.
To provide an exit route.
Exactly. It gives investors an exit route. They can try to sell their units on the exchange to someone else, maybe a distressed asset buyer, even if the fund itself can't pay them immediately. It provides a secondary door when the main door gets jammed.
Let's talk about switching. Moving money from Scheme A to Scheme B within the same fund house.
This is an operational convenience, but it can be a tax trap.
How so?
A switch is legally treated as 2 separate transactions. It is a redemption from Scheme A and a fresh purchase into Scheme B.
Which means
It means 2 things. 1, it is a taxable event. You might have to pay capital gains tax on the gains you made in Scheme A. And 2, any exit load that applies to Scheme A will be charged. So don't just switch because you feel like it. You have to calculate the costs.
Okay, dividend reinvestment, 11.8.5.
This is an option where instead of taking a declared dividend as cash in your bank account, it's automatically used to buy more units of the same scheme.
So if you get a dividend of 500 rupees and the NAV is 10, you just get 50 extra units.
Exactly. The benefit is compounding. Your base of units grows over time, so the next dividend will be even bigger.
Now, Section 11.9, systematic transactions. And of course, the famous SIP.
The systematic investment plan. You invest a fixed amount at regular intervals. For example, 5,000 rupees on the 5th of every single month.
And the big benefit is rupee cost averaging.
That's the one. The concept is simple. When the market is high and the NAV is high, your 5,000 rupees buys fewer units. When the market is low and the NAV is low, your same 5,000 rupees buys more units.
So over time,
your average cost per unit ends up being lower than the average market price. It smooths out the volatility and, most importantly, it removes the dangerous temptation to try and time the market.
okay, the reverse of that is the SWP, the systematic withdrawal plan.
Right. You tell the fund, pay me 10,000 rupees every month. They will then redeem just enough units at the prevailing NAV to generate that cash for you. It's a fantastic tool for retirees who need to create a regular salary from their investment corpus.
What's an STP, systematic transfer plan?
This is where you transfer a fixed amount from one scheme, the source scheme, to another, the target scheme, on a regular basis.
What's a classic strategy for that?
The classic strategy is to put a lump sum amount into a low-risk liquid fund. That's your source. And then you do an STP into a more volatile equity fund over, say, 12 months. It protects your principal in the liquid fund while slowly deploying it into the equity market, averaging your entry price.
And a DKP, dividend transfer plan.
Similar idea. Any dividend that is declared in the source scheme is automatically invested into the target scheme.
Now, here's a more complex one. The value averaging investment plan, 11.9.5. How is this different from a regular SWP?
This is definitely for the advanced class. In a SWP, the amount you invest is constant. It's always 5,000 rupees.
Right.
In value averaging, the target value of your portfolio is what increases by a constant amount.
Okay, let's use the example from the text. I want my portfolio to grow by 10,000 rupees every month.
Okay, so month 1, you invest 10,000 rupees. Simple.
Yeah.
Month 2, your target portfolio value is now 20,000 rupees. But before you invest, you have to check your current value.
So what if the market crashed and my 10,000 from month 1 is now only worth 9,900?
To get to your target of 20,000, you must now invest 10,100 rupees.
And if the market boomed and my investment is now worth 10,400?
To get to 20,000, you only need to invest 9,600 rupees.
So if the market falls, I invest more. And if the market rises, I invest less.
Exactly. It forces you to be a contrarian. It's a very aggressive version of buy low, sell high. The downside, of course, is you don't know exactly how much cash you'll need to have ready each month. The investment amount varies.
Finally, section 11.10, investment modes. The big one, direct versus regular plans.
This one changed the entire industry a few years ago.
How does it work?
A regular plan is what you buy through a distributor or an agent. The AMC pays that distributor an ongoing commission out of the fund's assets. That commission is a cost to the scheme, so the expense ratio is higher.
And a direct plan.
A direct plan is when you buy directly from the AMC or the R&T agent. There's no distributor in the middle, so there's no commission to be paid. Therefore, the expense ratio is lower.
So does that mean the direct plan NAV will always be higher?
Yes. Because less money is being deducted for expenses every single day, the NAV of the direct plan will grow faster than the NAV of the regular plan of the very same scheme. Over 20 or 30 years, a 1% difference in the expense ratio can mean a massive difference in your final corpus.
But the text also points out the role of the advisor.
It does. In a regular plan, the distributor is supposed to assist you. In a direct plan, you are either on your own, a DIY investor, or you hire a SEBI-registered investment advisor, an RIA, and pay them a fee directly for their advice. The idea is to completely separate the advice from the product distribution.
That brings us to the end of the chapter. We have covered a massive amount of ground here.
We really have, from the legal structure of trusts all the way down to the minutiae of value averaging.
If you had to pick the top 3 exam flags for our listener to review one last time before walking into that test center, what would they be?
Okay, top 3. Number 1 has to be the market cap definitions. Know specifically that large cap is the top 100 and mid cap is 101 to 250. They will test you on this.
Okay, number 2.
Number 2 would be the debt categories. Memorize the duration buckets. Know that a liquid fund is up to 91 days. Know that a short duration fund is 1 to 3 years. They will ask you to match the fund category to the timeline.
And the 3rd?
The 3rd is tax and lock-ins. Remember that an ELSS has a 3-year lock-in. A solution-oriented fund has a 5-year lock-in. And definitely remember the recent tax change for fund of funds. They no longer get equity tax treatment.
Fantastic. And for the bigger picture, beyond just the exam.
For the bigger picture, remember that all these rules and categories exist to create clear labels. As an advisor, your job is to look at your client's goal. I need money for my daughter's wedding in 2 years, and match it to the right label. You wouldn't put that money in a small cap fund, which is too risky, or a long duration bond fund, which has too much interest rate risk.
You'd look at a short duration debt fund.
You'd look at a short duration debt fund. Understanding the mechanics, the plumbing that we talked about today, helps you build the bridge between the client's need and the right product.
That's the mission. Thank you so much for walking us through Chapter 11. This was incredibly helpful.
My pleasure. You are ready for those questions now. Good luck.
Thanks for listening to The Deep Dive. We'll see you in the next one.